Hello, welcome to the May edition of Smart Money. We thought we'd open this Smart Money by welcoming some new clients that joined the firm over the course of the last few months. It's something I probably don't do enough of, but we really do appreciate it when new clients join the firm. It's how we grow and how we continue to expand and invest. So big shout out to Rose, Frank, Lorraine and Jenny. We welcome you on board. And we're also really pleased by the fact that all those clients came from referrals from existing clients, and that's really, at the end of the day, is a financial planning firm where you pick up your best clients. So thank you to everyone involved there. It's the end of May, so we're coming up on tax planning. 30 June's approaching in a couple of weeks' time, so we thought we'd just talk today briefly about some of the things you can do in order to manage your tax position for the run into the end of the financial year. The first thing is superannuation. The government did change the rules and regulations this year where instead of having a salary sacrifice, if for those of you who earn a wage, up to your maximum limits this year, which is $25,000, if you're falling short, for example, if your firm's only put in $10,000 or $15,000 for you, you can personally just make a contribution to the super fund of up to the gap, up to $25,000, and claim a personal tax deduction for that. So you no longer have to put it through the organisation or through your employer. That also goes for people who are not employed, who are under 65 years of age. You can also make a contribution to super up to $25,000 and claim a personal tax deduction, which you can use to, generally speaking, offset your other income. So generally a pretty good thing to do if you've got the capability to do so. The trick is, though, to bear in mind that the contribution has to be received by the super fund before the 30th of June. So don't make it on the 30th of June by BPay or something, because it'll be received in the following year and it won't count for this financial year. So make sure you do it a couple of days or a week or so beforehand and get that money in. A couple of the other things to bear in mind for the self-managed superannuation clients: just make sure you've made your pension payments. For those of you in either transition to retirement or full account-based pension, just make sure you've drawn out your minimums for the year. If you don't draw out those minimums, it can get really problematic and your account can get put back to accumulation and you don't want to go there. So just make sure you draw your minimums out. Another one that we talk about quite a bit, but I'll continue to talk about as well, is spouse splitting. So you do have the ability under some current rules and guidelines that allow you to move your contribution that you put into your name across into your spouse's name. And the key reason you want to do that is that when you get to retirement, you want to have both superannuation accounts relatively even, as opposed to a whole lot in one person's name and not too much in the other. So if one member of the party of the couple has a lot of the super and the other one doesn't have much of the super, then consider writing to your super fund and asking them to transfer the contributions from the account with the higher account balance into the one with the lower account balance. The one trick to be aware of with that strategy is if there is a significant age difference between the spouses. So if you're 65 and you have a 40-year-old spouse, if you move the money out of your name into the 40-year-old's name, then you're not going to be able to access the money for 20, 25 years or so. So if there's a significant age gap, you might want to reconsider that strategy, but if there's not, then it's generally a good idea to try to bring your contributions up on a reasonably even level. A couple of other strategies for end of financial year: prepayment of interest. If you do have an investment loan, you can talk to your bank about prepaying the interest on that loan through to the end of next year, and that just means you can get all the double the deduction this year. It can be really good if you've got capital gains that you need to offset that strategy. Income protection insurance is another tax deductible premium. So if you've got any income protection, make sure you pay the premiums up front and you pay it in this financial year, and you get the deduction this year as well. For those of you with discretionary family trusts, make sure you document to whom you're going to make the distributions before the 30th of June. I'm sure most of you in that position know to do that rule, but you can no longer work it out in hindsight. You've got to make the minutes before 30 June as to where your trust distributions are going to be distributed. Final couple of points: the new Downsizer legislation. This is the one where if you've lived in your home for more than 10 years and you then sell your home, there are some new rules that allow you to contribute those proceeds into your superannuation fund, irrespective of your age and even irrespective of how much you have in super. So you can have more than 1.6 million potentially and continue to put this in. We'll include a link at the bottom of the video with some more information on that downsizers legislation. But that comes into effect on the 1st of July. So if you want to take advantage of it, don't sell your house in June. Wait till next month. And of course, the final way in which you can manage your tax is to make a donation to a charity. As we mentioned before in the last Smart Money, we are looking to hike Kokoda this year. It'll be in August, and that will be to raise money for the Gate Unit at the Westmead Children's Hospital. And the Gate Unit is a unit there that teaches children with issues like cerebral palsy, etc., how to walk. We're hoping to have the website launched in the next couple of days, so hopefully by the beginning of June. So keep your eyes out for that, and obviously any deductions you make via that website, you get the tax deduction this year as well. So we look forward to your still supporting that one. Anyway, that's it for me for this edition of Smart Money. We trust you're all well, and if you want to pick up the conversation with any of those issues with us, please feel free to pick up the phone. We'll talk to you soon. Goodbye.